Welcome to the Free from Wall Street podcast, where we share how we have done over $200 million in real estate deals to create, preserve, and pass on generational wealth without the roller coaster ride of the stock market. If you're ready to start investing with purpose, visit freefromwallstreet.com. But for now, let's dive into this episode. What's up, Free from Wall Street? So today we're going to be talking about something a little bit different, and that is we're starting a fund. Why would we do that? So historically, we have been raising capital into each deal through its own deal-specific private placement memorandum, which is a great strategy. We liked it because when we had a deal, we could go out and bring our investors in. We decided what deal we're going to invest in ourselves. And then we say, come along for the ride, right? So we're pivoting that strategy to a fund structure. Why would we do this? There's a couple of reasons. One, we have more opportunity than we have been able to fund historically. So it's nice to be able to raise capital into a fund without a deal pending, right? Without the fire drill saying, hey, you have 60 days to raise this capital because we just got a deal. We know that we have more deals than we have ability to execute on right now. So we're going to start a fund so that we can get ahead of that so that we could fund more projects, gives our investors more opportunities. The biggest reason, right? The number one reason that we want to move to a fund structure than an individual investment structure is because risk. So we know internally that commercial real estate is one of the least volatile, more stable, less risky, quote, investments. And that's just based on a ton of data, right? That's not just our opinion. If you look at volatility calculators and the S&P over the last 50 years, commercial real estate has less volatility than most other asset classes. So that's why we like it, obviously. But there is still another couple of ways to mitigate downside risk. How do we do it? So a fund allows us to have investors invest into a fund and then aggregate that investment over everything that we buy in that calendar year. So historically, you invest in a deal with us and you go right into one deal, which is fine, assuming all goes well, right? But, we are of the mindset of we do three things, right? You've heard us say this a million times. We do three things. Number one is preservation of capital. How do we mitigate downside risk? How do we not lose money? Number two is return of capital. How are you going to get that capital back? And then three, what is the return on investment? And if you take care of numbers 1 and 2, we are big believers that number 3 will take care of itself. So this is another way to further de-risk an investment because now you invest into a fund. We buy 5 assets in that year, and you inherently, as a fund member, are invested into all of those deals, right? So if one doesn't hit the return profiles that we were projecting, then you have the other 4 that you can lean on. So you can diversify through asset class, geography, size of the building, things like that. So we like the fund structure because it inherently mitigates risk. Okay, so that's number 1. Number 2 is tax benefits. So the same tax benefits that you've been getting through investing with us deal by deal, we're going to have the same type of structure, except now all of the depreciation from those 5 deals for that year will get split up, what they call pro rata, or in step with your investment. So let's just use round numbers for example, right? We bought a $40 million building. We were able to write off $15 million, okay? We bought the next building was $30 million. We only wrote off $10 million, okay? So now we have $25 million in write-offs, but you have 2 assets. One got a little bit higher of depreciation. The other got a little bit lower in depreciation. If you were investing with us directly into those deals, depending on when you got in touch with us, would depend on what level of depreciation you would get. Well, not anymore, right? Through the fund, everything that we purchase in that calendar year. We will do those segregation studies, the cost segregation studies. The depreciation will then flow back to the fund first and then get divided up beyond all of the investors that came in that calendar year too. So it can just be a little bit more fair, right? So it'll equal out to where people are getting similar levels of depreciation based on being in the fund, not just one great project that had more depreciation. Finally, this is going to be a little bit different because not a lot of funds that you will seek out will do this for you, but we're going to do this. And I'm excited about it. So again, this is not a fund you can invest in yet. So this is not a solicitation. The fund hasn't been created. We're just talking to you guys through what we're thinking about why we would create a fund. Okay. So the third thing is the difference of distribution or reallocation. So right now, our investors are getting quarterly checks or monthly checks, depending on the deal that they're in, and we send them direct deposits, or we send them statements or checks or whatever. A lot of our investors don't necessarily want that money back. So some people, depending on their goals, want the cash flow because they want to pay for things in their life out of cash flow. That's what we do. We like to use cash flow to make passive income. Some of our investors like that as well. Others are just doing it for long-term wealth creation. So they don't want the money back. But when you invest into a deal, there's no way for us to take that money and roll it back into the deal so that you can compound that interest. So typically we're compounding people's money every 3 to 5 years based on when we sell the asset. Well, through our fund, we're going to be able to allow people to choose to reallocate back into the fund, which means it gets to compound much faster. And that also means that you won't be taking any income from that distribution, which means you don't have to pay the tax on that. I'm not an accountant. Talk to yours about whether or not that's true, but it doesn't create a taxable event from what my accountant tells me by distributing it back into the fund and not taking the income. So all pretty cool stuff. And then finally, so those are the three, right? And every marketer I know talks about how we should be talking about 3 best things or whatever, but there really is a fourth. And that's more liquidity. And that just means that after a certain time frame, right, you have an initial subscription period, and then you'll have access to that liquidity in the future, more so than you would if we held a property for 5 or 7 years. So that's the other piece of the puzzle that we really like, is more liquidity. So that is what a fund is, and that's why we are doing one. I like direct investment. We've always done that way. There's nothing wrong with that. But I also like the added benefits of being able to diversify into a fund. Now, if you go into a REIT, let's talk about Wall Street for a second, right? So, hey, Steve, I know some Wall Street REITs and funds that do real estate funds. Why wouldn't I just go invest there? You can, no problem. Sounds good. They do not typically, because of how they are structured, give the tax benefits and depreciation as a flow through back to the investors, right? We will do that. A lot of Wall Street REITs do not do that. I would argue none of them do that. But if you guys find one, let me know. I'd be interested to know which ones are doing that. But typically, because they're typically selling a security, and it's typically through a mutual fund or a packaged good or something else, they typically don't pass through those tax benefits, which is what we talk about all the time, right? That's why we like to invest in real estate, for the tax benefits. But if you go to a REIT and you don't get those tax benefits, then they're gone. So who gets them, by the way? That's right, the real estate firm that has the fund. Our structure is exactly the same as we would do on a deal-by-deal basis, but now in a fund structure. So anyway, hope that is helpful to you guys. I hope you look into fund structures or reach out to us and join the investor club so that we can talk to you about our fund structure when it gets created. But that's what's been on my mind today. It is a couple days after Thanksgiving, so happy Thanksgiving. Grateful for you guys that are listening. Hopefully you enjoyed your time off, or just time with the family, and you spent some time counting your blessings and talking about what you are grateful for. We are grateful for this business, for our team, for our investors, and of course, for you guys that are listening in the Free from Wall Street world. So get out there, take control of your finances. Till next time. See ya. Thanks for listening to the Free from Wall Street podcast. If you like what you hear, leave us a rating and review and let us know what you think.